Hi, everybody. I'm John Nersesian, Head of Advisor Education at PIMCO. Let's turn our attention to tax planning for 2023 by starting with ordinary income taxes. We know that here in the United States, we're subject to a progressive tax system that starts at 10% and rises to a maximum level of 37% for families at $693,000 or more. There are additional taxes that we need to be conscious of as well, specifically affecting families with incomes above $250,000. These are typically referred to as ACA taxes, or otherwise known as Obamacare taxes. There are two components. The first is the Medicare hospital tax of 0.9%. Now, this is levied against active forms of compensation. Think about my biweekly paycheck or my annual cash bonus. The net investment income tax of 3.8% is once again levied for families with incomes above $250,000 on passive forms of compensation. Think traditional investment activities, such as net realized capital gains, interest, dividend payments, and real estate activities. Once again, both of these taxes affect families at $250,000 and above and are applied above and beyond their ordinary federal income tax rates. There's another tax that investors need to be conscious of, although its bite is not nearly as sharp as it once was. It's the alternative minimum tax, and I guess I have good news and bad news. The bad news is that the alternative minimum tax is still here. The good news is that its reach has been significantly curtailed. Here are the reasons why. The alternative minimum tax comes with an exemption amount, and that exemption amount today is significantly higher than it's been in past years. The exemption amount for 2023 is $126,500 for clients who file a joint tax return. And the full amount of that exemption is retained until a client's income exceeds over $1 million when a phase-out begins. But there's a second reason that the alternative minimum tax is less likely to affect our clients, and it has to do with the reduction in traditional deductions available under the regular code. Those deductions are more limited today, suggesting that a client's regular tax bill is likely to exceed their alternative minimum tax bill. The AMT affected over 5 million taxpayers prior to tax reform. Today, that number is closer to 500,000. So while there are still some clients who might be affected by the AMT, the vast majority of clients who were once affected most likely no longer are. Here's our first planning opportunity, and it's to manage taxable income to achieve the very best tax outcomes. Now, in traditional years, when clients are actively employed, facing a high marginal bracket, the general strategies are to reduce their taxable income and to accelerate their deductions in an attempt to lower their tax liability in the current year. Clients can accomplish this by contributing more to their retirement accounts, by giving more under the charitable giving premises. They can avoid or can recognize capital losses to offset capital gains that have been realized in their portfolios. And they can defer retirement account distributions up until RMDs as a way of lowering their taxable income and reducing their tax bite in the current year. But what about clients who find themselves in a temporarily lower marginal bracket? Maybe our client recently retired. Maybe our client changed jobs and found that their income for the year was significantly reduced. In those circumstances, it may be advantageous for clients to selectively recognize income, to have it realized at a lower marginal rate in the current tax year, as opposed to realizing it in years in which their marginal bracket might be higher. The planning opportunities are counterintuitive. It's to maybe delay my charitable giving and to save those dollars for another year. It's to recognize capital gains, to have them taxed at a lesser marginal rate. Maybe a Roth conversion makes sense as an opportunity to realize the income subject to a lower marginal rate today in exchange for tax-free compounding over multiple years. One way to lower clients' taxable income, of course, is to contribute to their retirement accounts. At a minimum, clients who participate in employer-sponsored 401ks should be contributing the amount that is matched. This is a free opportunity for clients to build resources for their retirement preparedness. Here are the limits that are affecting 2023 taxpayers. Traditional IRA contributions are capped at $6,500 with a $1,000 catch-up provision. That same limit applies to Roth accounts as well. 401ks and 403bs, that amount has been increased to $22,500 with a $7,500 catch-up provision. For clients who are maybe self-employed or run their own business, sub-plan contributions extend the opportunity to contribute up to $66,000. And for clients who are looking to aggressively fund their retirement account plans and to maybe lower their taxable income, can consider a cash balance plan where contribution limits extend beyond $200,000 as a way of lowering their income and accelerating their retirement savings efforts. Now, one of the challenges faced by many clients is this choice between a traditional retirement account and a Roth retirement account. We know that traditional IRAs are subject to AGI limitations, which may make their contributions either deductible in full, partially deductible, or potentially non-deductible. But for many clients, there's this challenge or opportunity to choose between a traditional retirement plan and the Roth variety. Let's review the basics behind this decision. Traditional retirement accounts provide a unique benefit of an upfront income tax deduction, lowering my taxable income for the year and my tax bite in my current taxable year. The money grows on a tax-deferred basis, but then, of course, I pay taxes when these dollars are distributed, beginning at age 59 and a half, or maybe when RMDs begin at age 73. The Roth account works in the opposite capacity. Roth plans do not provide an upfront deduction, provide me with tax-deferred compounding, but then produce tax-free distributions when the money is eventually distributed. Another benefit of the Roth plan, which may be somewhat less obvious, is that unlike traditional retirement account contributions, Roth plans are not subject to RMDs, affording savers and families the opportunity to continue to compound these dollars that may not be required for retirement funding, and to allow these dollars to compound on a tax-free basis for an extended period of time. Another retirement vehicle that is maybe less well-known and used to a lesser degree is the HSA. Now, full disclosure, the HSA contribution limits are significantly lower than other opportunities. The maximum contribution limit for 2023 is $7,750 per family. There's a $1,000 catch-up provision that begins at age 55. But the HSA provides the best of many worlds. It provides an upfront income tax deduction, lowering my tax bill in the year of the contribution. It provides tax-deferred compounding and growth for the monies that are left in the account. And then when eventually distributed for qualifying medical expenses, these distributions are tax-free. The HSA can be a very effective supplemental retirement savings plan beyond traditional IRAs and 401k plans. For those of us who work with the unique cohort, the closely held business owner, specifically pass-through entities, S corporations, sole proprietorships, those who are self-employed, those individuals calculate their tax liability under their S corp return, but they're entitled to receive under TCJA a 20% deduction on their net income before it's applied to their personal tax return. This is known as the 199A or the QBI, the Qualified Business Income Deduction, available to these unique individuals. There's a catch. For specialized service businesses, there is an AGI limitation that may reduce that 20% deduction. Managing client income for these affected individuals is critically important to maximize that deduction. Clients will want to look at retirement account contributions, deductions available to the closely held business owner, charitable contributions, and other methods to manage their income in an attempt to avoid the AGI phase-out that would typically accompany this 20% QBI deduction.